Hello, everybody. Welcome to another episode of the Mountain Zoom. And this evening we have Laura Powers. She is an area farm management specialist with the University of Kentucky College of Agriculture, Food and Environment, and she's actually based out of Hopkinsville, Kentucky. And she's going to give us a very good topic that if you're in anything in farming, is something that you definitely need, is farm tax information. So she's going to give us a great program here this evening on farm tax updates. So without further ado, Laura, I really appreciate you coming tonight. I'm going to go ahead and turn it over to you.
Okay, sounds good. I'm really happy to be here and share a little bit about farm taxes. I know it's not everyone's favorite subject, but sometimes it's some of those things that we do need to know if we have good information, and that can help us make good decisions. So I'm happy to hear and share with you. As Jeremy said, my name is Laura Powers. I'm an area farm management specialist. I am part of the Kentucky Farm Business Management Program, and we are a little bit unique as far as being in the College of Agriculture and working in extension. We are a joint program between 4 local associations in Kentucky and the Department of Agricultural Economics. There are 8 specialists currently in the state, and we each have 40 to 50 farms that we work with on an individual basis. We help them with record planning, with record keeping, with tax advising. We do not prepare taxes as a part of the program. That is something that we don't do. But we do spend a lot of time with tax advising, tax planning, and those types of things. So we do get pretty familiar with some of the farm tax issues. As Jeremy said, I am located in Hopkinsville, Kentucky. So I do work with a number of different farms than what many of you may have, but still tax information is tax information. So let's just jump right in. I'm going to try to keep things fairly general. It seems like when you talk about taxes, you can either do general information or you can really get down into the weeds. And I'm going to stay fairly general with that. But if you have questions, I hope that you will ask questions and we will try to get those answered as we can. So one of the first things I want to share is talk about is farm tax deadlines. Today is February the 22nd, and so we are coming up on a big tax filing deadline for farmers, which is May 1st. But farmers do have several options when it comes to when they file and pay their taxes. Generally, most businesses are required to pay quarterly estimates. So they have to pay an estimate of what they think their tax bill will be for that particular tax year. But farmers have an option. They can still pay those quarterly estimates during the year, make 4 quarterly estimates during the year, or they can pay one full estimate by January 15th of the following calendar year. So for the tax year of 2021, farmers could pay a full estimate of January 15th of 2022, and that estimate would be 100% of the tax that was due the previous year, or 66% or so of what they think their tax bill will be for that tax year. If they pay that estimate by January 15th, then that will actually extend their filing deadline to April 15th or 18th, whatever it may be. Otherwise, farmers are required to file and pay in full their taxes by March 1. So like I said, farmers do have options on when they want to pay and file their taxes. And on a similar subject, I wanted to throw in about the Kentucky sales tax exemption form for farmers. They have made some changes to that, and we are now in a position where farmers will need to apply to the state of Kentucky to get a sales tax exemption number. For those that had been farming in 2021 and prior, the application deadline was January 1 of 2022. So if you didn't get that application in by January 1 of 22, you will actually have to wait until 23 in order to get that exemption. However, for this first year, you are still able to use the current form, which is just dependent upon your driver's license, to be exempt on those items that you could be exempt on the sales tax until June of 22. So that would still apply. But after that date, if you do not have your new Kentucky sales tax exemption number, you will not be exempt from sales tax on certain items that you may be exempt on. Then you would have to wait until 2023 for that. I was given a few ideas of what some people may be interested in, so I'm going to go through some of those. One of those were the PPP loans, the program, payroll protection program loans. Those started in 2020, and then in 2021, as a result of some of the COVID issues that we were faced with. These PPP loans, you could apply through a lending institution, and you could get a potentially forgivable loan, and it was based on payroll in your farm, rent paid, some utilities or lease payments, and you would apply, you could get some money. And so the question has been, well, how is that related to taxes? Well, part of that program is that we need to know if it's been forgiven. As I said, it's potentially forgiven if you can demonstrate that you use the funds for the stated purpose of those loans. Then it's certainly possible that those loans could be forgiven. And the good news is once those loans are forgiven, first, the amount of the forgiveness is not taxable income, and you are still able to use the expenses as expenses and not have to reduce your expenses by the amount of the loan. So a lot of people got those payments based on payroll, so you were still able to deduct the payroll expenses as you normally would, and not have to call these loans, once they're forgiven, any kind of taxable income. So it was very much a win-win. Now, if loans haven't been forgiven, it still would not be taxable income because those portions of the loans you would have to pay back. Now, we also had a number of farms that would get a PPP loan based on their own self-employment income. And in that situation, again, once it's forgiven, the loan amount is not taxable income, but in that case, there was no deduction for expense because you are not able to pay yourself a wage if you're self-employed. So it's still no taxable income to be seen there. Farm vehicles. I had a question about how to deduct the use of farm vehicles. It's the tricky case can be if you have a vehicle that is used for both on-farm use and then for personal use. So two options when it comes to vehicles on how we may deduct the expenses for those. One would be the actual expense of the vehicle. The other would be using the mileage rate, the federal mileage rate allowance for those vehicles. And you do have to choose one or the other. You cannot use both. So if you choose the mileage rate, and I make a note on the slide that for 2021, that mileage rate was 56 cents per mile. And for 2022, it's 58.5 cents per mile. So if you want to use the mileage rate deduction, then you will need to keep mileage logs, mileage records. Generally on the tax form, there's a section that asks how many miles was this vehicle used during the year, how many of those miles were personal miles, how many of those miles were business miles. To justify this, if you ever need to justify it with the IRS, they would want to see some kind of logbook information showing, mileage daily, weekly, and so forth to justify the mileage rate deduction that you would be using. I do not have anyone that uses the mileage rate. There's a lot of record keeping involved with that. Most of the farms that I do business with, they will use more the actual expense. So the actual expenses as far as the vehicles would be the cost of the vehicle, which we would account for by putting that vehicle on the depreciation schedule. And generally vehicles are depreciated over a 5-year life. We would also have repairs, fuel, insurance. Those would be some of the other actual expenses that may be associated with that vehicle. Now, if that vehicle is used for less than 100% business use, then we must prorate those items. So if a farmer were to purchase a truck and they're going to use that for farm and for personal, and they know that it's going to be 50% business use, then only 50% of the cost of that vehicle would go on the depreciation schedule. Now, when we get to less than 100% business use, then we have some considerations that must be made when it comes to any accelerated forms of depreciation. And I'll talk a little bit later about some of those accelerated forms of depreciation, such as Section 179 and the bonus depreciation. I want to talk a little bit about when is farm income farm income. Most farms, again, they have a lot of options, and one of those options that other businesses don't get is that they can pay taxes on a cash basis. And so that means that income is reported when it is received and expenses are deducted when you write the check for them. Okay, now there will be some limitations with this that we'll go into. So there's this little thing that the IRS calls constructive receipt. This means if you have reasonable access to a crop sale or something that you have sold, there may be cases where you maybe don't actually have the check, but it is still income. Again, I mentioned I'm in Hopkinsville, Kentucky, so I have a lot of grain farms that I do business. So if I have a grain farm that takes their grain to the elevator and they tell the elevator, well, I just don't want my check today, I want you to hold it and I'll come get it, first of next year. Well, if the elevator has cut that check, they have set aside funds for that particular farmer, they just haven't picked it up, that is still going to be considered in most cases constructive receipt, meaning that the farm has actually received that income. They have just chosen not to go pick up that check. We used to see this a lot with, say, tobacco farmers. They like to go down to the tobacco warehouse, they pick up them checks and they stick them in the drawer somewhere, and they would decide, well, I just haven't put that money in the bank yet. Well, you have the check in hand, putting it in the desk drawer doesn't mean you can not count it for income in that year. And this kind of caught some farms by surprise a few years ago when some of those tobacco warehouses went to a direct deposit. So, in some even legitimate cases where farmers didn't sell their tobacco until the first of the year, and then they sold tobacco at the end of that same year, they had to pay tax on essentially 2 years worth of tobacco receipts. Another thing that we see quite often and that you really need to pay attention to is with crop insurance. And I do some tax education seminars with tax preparers in Kentucky as far as UK income tax series. And one of the things I always ask our tax preparers to pay attention to is those crop insurance 1099s. If a farmer is sometimes expecting a crop insurance payment, they had a loss, whether through for some yield damage or even revenue side, and they get a crop insurance check, sometimes those crop insurance companies will deduct a premium that is due to them from that check. And so the farmer just gets a net check. So I really want people to pay attention that even though if that premium is deducted, we still want to make sure that the full amount of that crop insurance is reported as income on that crop insurance line on the Schedule F. And then, of course, any premium that was deducted is included as an expense. So the net result is the same, but we want those numbers to match. So I think it's important to pay attention, especially on those items. And similar with cooperatives, if you do business with a cooperative, some local southern states is a cooperative you may have in your area. If you do enough business with a cooperative, then they may send you a patronage check. And it's important to note that for many cooperatives that they do not send you 100% of your earned patronage back in the form of a check. Patronage is tax, you do have to pay taxes on that, but sometimes they may only send you a check for 40% of the patronage that you earn for that particular year. So even though they only send you 40% of that back, you still have to pay 100% of that on the tax in that year. And then in the year in which they revolve that patronage, then it is not taxable income at that point because you'd already paid tax on it. So those are kind of two important things that are a little bit odd about being cash-based, and maybe you didn't get all that cash in that year, but you still had to report those as taxable income in those years. On the expense side, generally, if we're going to deduct an expense for a farm business, then it must obviously be for business use. And, fuel, chemicals, insurance, property tax on the land that you use in farming, those are all, farm business deductible expenses. And I think, we pretty well understand what most of those things would be. Now, when we come and talk about a tax issue on expenses, a lot of times what we talk about are the rules with prepaying expenses. Again, being a cash-based taxpayer, we are allowed to pay for an item in one year, deduct it in that year, and we can deduct it in that year so long as we use it within the next 12 months, okay? So one of the things that we do with farm analysis, our December and sometime earlier as November, we spend a lot of time in tax planning. So we're looking at our farm's income and expenses and seeing where they are to see if they maybe need to prepay some expense, or if they maybe need to collect some income to help manage that tax liability. But there are some rules with these prepaid expenses. First, as I kind of alluded to, the inputs, they're those items that we are purchasing, they must be used within 12 months of the date of purchase or before the end of the following tax year. When we are prepaying goods, a lot of our farms will prepay things such as fertilizer, chemical, seed. They must be purchasing a specific quantity at a specific price. We cannot just put money on deposit. I can't just go write $50,000 to my local supply store and say, well, this is money I'm going to use with you next year. No, that's just putting money on a deposit. I must say I'm going to buy, you're setting a certain price of goods, so many tons of fertilizer, so many pounds of chemicals at a certain price. And again, most of the common prepaid types items will be fertilizer, chemicals, seed, fuel. We'll have some people that may be able to book fuel at a certain price and be able to prepay that. Feed expenses, we can prepay feed. Now, some things that we cannot prepay. One is that we cannot prepay interest. We can go to our bank at the end of the year and we can pay all of our accrued interest. So if our loan payments, if we have a term loan with the bank, we make annual payments, and that annual payment is due in June, and we make that payment in June, well, by the end of the year, there has been interest accruing with that loan. I can go to the bank, pay my accrued interest, everything that's accrued to that date, but I cannot pay interest that may be coming in the next year. And actually, that's prepaying interest paying of my accrued interest is one of my favorite farm management type of prepaids, if you will, or end of year spending. If we're looking at managing tax liabilities, that's a good management decision, I think. Another thing that we cannot prepay would be leases. We may have farms that want to lease equipment. They may be set up on a 3 or a 5 year lease. Well, we can really only pay that lease 1 year at a time. I cannot, in the first year of that lease, go ahead and pay for the first 3 years of the lease. I can only deduct that lease payment 1 year at a time. Another item that we need to look at as far as when we can deduct that, will be if we're in the business of like cow-calf operation or a market livestock operation where we're buying calves, we're feeding those calves, and then we sell those calves. We are only allowed to deduct the cost of those market livestock in the year in which we sell them. So if I buy 50 calves in June, and if I feed them out and I only sell 20 of them before the end of the year, then I have to prorate out the expense of those purchased ones, and I can only deduct the cost of the ones that I sold in that year. And then the rest of them gets carried forward until I sell those. So that's another one of those items that even though we are cash-based taxpayers, we can't always just deduct the cost of something in the year which I spend it. And again, when we're looking at prepaying expenses or managing that tax liability, we do want to think about any potential tax consequences. We want to think about, what will incomes be in the next year? What our tax rate's going to be doing? It may not always be to our advantage to get our tax liability down to as low as we might think we want. We really need to do some planning on some of those things. And I especially encourage you to talk with your tax preparers in making sure of what the issues may be. Capital asset purchases. We all know how capital intensive farming can be. So I wanted to spend a few minutes talking about capital asset purchases, the way that we expense capital assets. And we're talking about, of course, tractors, tiling, any kind of the main items that we use on a farm that we're not going to use up in that first year. We capture those expenses through depreciation. And in order for something to be depreciated, it must be available and placed in service. We cannot just go to our tractor supply store or tractor dealership and put $10,000 down on a tractor and expense that deposit in this year if we're not going to get that tractor until next year. So it does need to be available to be placed in services. And the line on the slides is no more like-kind exchanges. They changed the tax rules a few years ago. And when we did a tractor trade, we traded in our tractor and bought a new one, we used to only be worried about the difference, the book that we have in that new tractor. Well, that was because we did a like-kind exchange with those assets. Well, now for farm machinery, we do not have that like-kind exchange. And I think this can actually end up being a good thing. So what we do now is if I buy a $100,000 tractor and then I trade in my tractor and they allow me $20,000 for it, well, if I wrote an $80,000 check, okay, or I financed $80,000, whichever it may be. Before, a few years ago, we would write that check for $80,000 and then we would be expensing an $80,000 tractor. However, now the rule is we are purchasing a $100,000 tractor and I sell my tractor for $20,000. So we can work with accelerated depreciation if we need to be able to net the difference to make it similar to the way it was before. Or if I don't need all that expense and I now have a $100,000 tractor that I can depreciate and have more expense that I can work with on depreciation. So that is a little bit of a change over the last few years. So how do we depreciate farm assets? Their IRS has a guide that they have a standard guide about how many years we will depreciate certain assets over. Now we have some options on accelerated depreciation where especially if one of the farm planning tools that I like to use is when it comes to accelerating depreciation. If we are having to borrow money to purchase the tractor, the forage harvester, cattle, breeding cattle would go on a depreciation schedule. If we're having to borrow the money for those things, and this is kind of what we're dealing with right now in farm analysis when we're processing books for the previous year, I don't always like to use accelerated depreciation if I'm having to finance, I'm sorry, it's the end of the day and I can't talk anymore, finance those assets. Because otherwise I want my depreciation to match when those term payments may be. That's a good offset. But two options we have for accelerating depreciation. One is bonus depreciation. That is a defined percentage by the IRS, and it's taken in the first year that asset is placed in service. The last few years, we've been working under rules that the bonus depreciation is 100% of the cost. And in 2023, I believe it begins to step down, it goes to 80%. And then it will decrease by 20 percentage points until it goes to 0. That is at least how the rule is now. That is always subject to change by Congress, and generally it does change, but that's where it is now. Section 179 is another option. That is a dollar amount that we choose. Now there's a overall dollar limit that you have to use Section 179. It's a little over $1 million this year that you can deduct and put Section 179. And so you can choose a certain amount. That $100,000 tractor, I can use section 179 if I need just an extra 20,000 of depreciation, or 50,000, 80,000. We can choose the dollar amount on the assets, as opposed to bonus depreciation. When it's 100%, it's either all or nothing. And anything on 179 that isn't taken, then we put that on a regular depreciation schedule. And in general, it's also important to know if those farm assets are new or used. That can change the years in which the assets are depreciated. Next slide, and I don't know if the text on this is pretty small, but this is a table from the IRS Publication 225, the Farmer's Tax Guide. This shows how long various items would be depreciated over. And there's some additional tax planning strategies with this. You'll see there are two columns. There's a GDS column and an ADS column. These are two different types of depreciation method. And the point with this is that depending on your situation, I have some farms that even, let's say, cattle, okay, cattle, whether they're used for dairy or breeding. The GDS recovery period is 5 years. However, for ADS, it's 7 years. So if you're in a situation where if you had to take you purchase some dairy cows, and if you put them on a 5-year cycle, then that would push your income lower than you really like. You can choose to use the ADS form and use a 7-year recovery life. So cattle would, but most people will use GDS is the most standard, but I have had situations where we have used that ADS form of depreciation. If it's new farm machinery or equipment, that is a 5-year property. If it's used farm equipment or machinery, that would be 7-year property, at least under GDS. Grain bins are 7 years. Semi-trucks would be 3 years. Breeding hogs would be 3 years. But you can see this is a nice little table to have to give you an idea on the recovery period for various farm assets. Buildings, we do have some discussion on buildings. There are single purpose ag structures, and those would be 10-year buildings. Those would be your greenhouses. Some livestock facilities would be 10-year buildings. If there is any chance that you can do anything else with those buildings, if you think it may be a single purpose, but if there's storage room, anything else, then most likely it's going to end up being a multi-purpose building, and that has a 20-year recovery over. Switching gears a little bit, I wanted to talk a little bit about employees versus contract labor. We have these discussions quite often with our farms. Certainly it is much easier to pay someone as a contract labor because you do not have to do any payroll tax deductions on them. However, we have to have the conversation. It depends on the situation if someone is actually an employee or if they're contract labor. If it is someone that you have hired to come work on your farm, you direct their activities, you tell them when they need to arrive, what time they end for the day. If they are using your tools, your equipment, then that is an employee, and you would be required to do the necessary payroll tax withholdings and make those deposits. Now, if it is someone that you hire them and you tell them that there's just a specific job that needs to be completed, they work on their own schedule, they use their own equipment, and you just tell them the job that needs to be done, and they do it in the manner that you have less direct authority over them, then more likely they're going to be contract labor. And in that case, then they are responsible for any taxes, their self-employment taxes, and you generally do not make any deductions. Now, even with someone that is true contract labor, and you would be required to get their name, address, and either an EIN or their social security number. If they are unwilling to give you that information, then you would be required to do, I believe it's a 28% withholding on those wages. So you do need to make sure that you get their tax ID number, because even contract labor, you would be required to send them a tax form. So if it's an employee, they would receive a W-2. A contract labor would receive a 1099 NEC if they are paid more than $600 for the year. And as I was putting this presentation together, I thought, well, if we're going to talk about 1099 NECs, let's talk about some other 1099s that would be required. Rents, rent paid to someone in an amount greater than $600 would be required. You would be required to send a 1099. Veterinarians, attorneys, if you pay interest to an individual. And in some situations, we will have that a landlord share. I'm sorry, I see somebody is wanting to come in. Let's let this person in. If you have a landlord that, you know, they own the land, you farm the land, and you pay them a share of maybe your government payments or a share of the crop insurance, then you would want to put that on a 1099 to send them. And of course, any machine hire work would be sent a 1099. If the recipient is incorporated, generally we do not send them 1099s. However, attorneys, I believe we pretty well send attorneys for any payments more than $600. I believe my final slide are a few handy little resources I wanted to share with you. The IRS has a number of publications that are really good for more tax advice. Pub 225, I believe I mentioned this earlier, the Farmer's Tax Guide. That is a really comprehensive, it's a good guide to go through if you have further questions. There's also Pub 51, the Agricultural Employers Tax Guide. So if you have employees, then that publication can help guide you through that process and how to properly do withholdings. There's ruraltax.org, and that's a rural tax education website, and they have a number of tax topics that you can look at. And then the KFBM website there, agecon.ca.uky.edu. Some good resources there for you if you have further questions. With that, Jeremy, I don't know if we've had any questions, but I will go ahead, and this is my contact information. I will put that up, and I'm certainly happy to be with you. And if there's anything that I can help, please ask.
Laura, thanks so much. Thank you very much for this great information this evening. I guess I've got a couple of statements, questions, that sort of thing. First of all, if you're going to do this, I presume you need to find a good tax accountant.
Absolutely.
Somebody who knows at least business worthy, but if they know farm business, it's even better. You're not going to take this to your the personal tax tax groups that you see. You're going to have to find somebody that's got some knowledge in business, at least, and farm business is even better, I presume.
Yes, yes, farmers, because they are definitely a special group. They have a number of rules that they can work with that other businesses don't. So really finding a good tax preparer that is knowledgeable in farm would be very important.
Okay. And I presume one of the things would have to be, you know, filing that Schedule F. Yeah, that's one of the main things there. And also, you know, as extension agents, we typically get the deal of, do you have to make money to be a farm business or what have you? Would you just briefly kind of explain that of to actually qualify as a farm business?
Sure. Generally, there are things. No, you do not necessarily have to make money with it. Now, you would want to be careful that you don't get considered a hobby. You do need to show that you are in the business to try to make money. You know, you do need to have perhaps not necessarily a written business plan, but you do need to have the intent to try to make money. The IRS has some rules about if they think you are a hobby business, then there are some rules about loss deductions and so forth. that you'd have to be careful with. But even though you don't make money, still does not mean that you're not a farm, so long as you're trying to do things that you could make money.
Okay, and I presume that good tax accountant that you reach out to can definitely help with this, correct?
Yes, that is for sure. That is for sure.
And I know, we in extension, we don't normally recommend accountants and that sort of thing, but there are really good ones out there. And I would just, I presume the best thing they could do is maybe ask other farmers, ask simple business owners. I think that would be a good idea, wouldn't you think?
Absolutely. Word of mouth is one of the best things that, farmers will do. Hey, who does your taxes? Are you happy with them? Absolutely.
And that's a good thing. And another thing that jumped off the page here at me is one of the first slides that you had. It had to deal with Kentucky state tax, the sales tax being
Yes.
exempt. And
Yes.
so everything right now is pretty good for 2022, that all you need to do is
Up until June.
until June. Okay.
Until
You don't,
June. Yeah,
okay.
the new rules will kick into effect June 2022.
Okay.
So
Awesome.
up until that point, you can still, it's the same type of form that we've had. It just depends on your driver's license. You have to give them that. But after June, hopefully you will have that form back from Kentucky if you applied before the end of the year. And then that has an ag exemption number on there. If you didn't, then unfortunately, and you were a farmer in 21, then you will have to wait until 23, probably reapply at the end of 2022 to get that number for 2023.
Okay. Good deal. Also, another loaded question here. What type of ag business actually qualifies for that exemption?
Any ag business. A farmer can do that. It's all you have to do is say that I don't have the form in front of me to remember. If you certify that you cultivate the soil, then that qualifies as a farmer, and certain supplies that you may purchase would be exempt from the sales tax.
Okay. That
Or
definitely,
animal livestock as well, if you raise animals, livestock as well. So forgive me, I have a tendency to go toward the grain side. That's what most of my farmers do.
right. And I know that, there's some things you and I talked about earlier. There's some things that are, possibly qualify with forestry, with even a large horticulture, that sort of thing. And basically, it goes back to getting with that good tax accountant. If you don't have one, get with somebody that's a really good tax accountant. Even if you're just a small farm business, I think that would be beneficial, definitely.
Yes. Tilling or cultivating the soil for the production of crops as a business. So anything that would be defined as a crop in which you till and cultivate the soil, raising and feeding livestock of a kind of the products of which constitute food for human consumption, raising and feeding poultry for breeding or egg production, dairy operations, and then various other aquatic animals, llamas, alpacas, all kinds of sorts. So it's a pretty broad list.
Definitely. It sounds like it. Well, definitely great information. Any questions from anybody out there? I see we have one that joined us just a few seconds ago. If there's any questions, you feel free to type them in the chat pod or unmute either one. But great information, Laura. We really appreciate you coming on tonight and joining us.
Thank you for having me
on this nasty rainy night here. It seems like all across the Commonwealth of Kentucky and Virginia. This will reach some folks in Virginia as well. So across both Commonwealths, I think we have a lot of rain tonight. So those ag ventures in the morning are probably going to be nasty, wet, and soupy.
Get them mud boots out.
Yeah, definitely. Well, Laura, since there's nothing else there, we really appreciate you logging on this evening, and I guess it's technically 5:45 where you're at. So,
It is. It
and
is.
but thank you very much for logging on and sharing this great information with us. And we definitely appreciate it. And so I guess that's all we have this evening.
All right. Well, thank you very much for having me. I do appreciate the invitation.
Awesome. You're very thank you very much. And you have a great evening. And we'll see everybody on the next Mountain Zoom.